keeps getting better, huh?
Yeah.
Let's see. Let me see. Look here. See if people can come on in. Yep. Andrew, come on in. We'll just open the doors. The great thing about webinars, we got a front row seat. Christina, welcome. Hey, to make this more interactive, we're gonna have a pretty tight group here. To make it more interactive, if you want to open up your Q&A box or your chat box, put your, if you want, put your company, what industry you're in, and what city you're in. And that way we can interact a little bit more. And we're gonna get started just 2 minutes after the hour. We're expecting more than 2 people. We have a small, tight mailing list. So we're expecting about half a dozen to come in. Right. Take a look. Yep. Hey, Andrew, where is that? I want to say a lion, but it's probably not pronounced that way. That's my Texan pronunciation. A leon. Yep. Let's see. And Christina, where are you? If we have just a small, if there's just 2 people, we want to open up, we can talk, interact. Make it a private tutoring session or collaboration. Yep. So I'm gonna for both of you, I'm gonna open up where if you want to talk, you're welcome to just interact with us naturally. Small group. Expecting about 6, but I don't think it's gonna happen. So Jose, why not are you ready?
Yeah, I'm ready to roll.
You're not launch into it. So bold moves, right? Inflation and low financial performance. So inflation is breaking news. Secondary to the people capacity crunch, maybe secondary to the supply chains, and certainly Russia invading Ukraine is taking up a lot of the airwaves. But what Jose and I are going to do, we're going to lay the groundwork from a growth CFO best practices. In fact, beating inflation, making those adjustments are something that we should do every year, even if it's not relatively high inflation compared to what we're used to, because inflation just erodes the margin, make less profit, less household income, and it makes your business less valuable. So beating inflation, making these adjustments, really, other than being intentional, it really doesn't cost you anything, but it increases profits, accelerates cash, and makes your business more valuable. So Jose and I are going to guide you. For those of you who don't know me, my name is, I see Craig there, one of our CFOs. My name is Kirk. I'm the CEO of Foresight CFO, and I teach financial management to graduate students at Georgetown University. In addition, I'm the husband to 1, father to 2. Both my sons happen to be Army officers. So you're going to see some of that flavor where, how do we drive the outcomes that you need in a very intentional way. So I'm delighted to have Jose here to guide us through the highlights of how to do better about inflation. Jose, do you mind introducing yourself a bit?
Yeah, hi. Hey, Andrew. Hi, Krishna. And Craig, I know well. First of all, thanks a lot for taking the time to sit down with us here for a little while and have this conversation with us. My name is Jose Villarino. My experience goes everything from Silicon Valley, where I kind of grew up professionally, personally, all the way through into private equity in the airline space. And literally the last 10 years or so, I've spent all my time working with small to medium-sized companies, trying to make the leap to that next level. And what are the things we need to do as a team to get that right valuation, free up that cash flow, and ultimately get that entrepreneur or that leader to where they want to go. And that's where Kirk and I came together. That kind of philosophy around how to work with clients and how to help people get to their goals. And it just happened to be the vehicle was Foresight CFO, and more specifically, my unique skill set when it comes to numbers and my facility with finance.
Yeah, definitely. So the layout as growth CFO, Foresight's purpose is to ensure that CEOs are getting higher revenue, more profit, better cash flow, and building a business that's more valuable. Equally important, a business that's not dependent on them. So you don't only get the financial outcome, but you get time back if your business is not dependent on you, and you have more succession options when it comes to it. The roadmap to how to do even better is laid out. Our book is, we wrote our book. It's due to be published by Forbes on June the 14th. It really shows where the CEOs get stuck from where they want to be versus where they're at, and how to get unstuck. So grab a copy of our book when it comes out in June. It's going to be a bestseller, and if you ask, I'll sign it for you. So to beat inflation, after this call, if you want to jump in and do a 25-minute discovery call with me, then I'll find out more about your business, your objectives, and kind of what the stall points are, what's keeping you from getting there. So definitely jump in and do that discovery phone call. So the world today, I mean, I'm 52 years into this life, and I can remember things as far back as the oil shocks, and kind of coming forward, we'll talk about from a perspective standpoint about inflation. But the world is complicated. I mean, we're 2 years into a pandemic. Last year, I mean, I think a surprise to most is that the Great Resignation, where 24 million people left the workforce. People figured out they had enough and they quit. Some are going on to do other things, kind of the gig economy. Some are left and they don't plan to come back, right? So now there's we're almost a month into war in Europe, with Russia rolling tanks into Ukraine. My son happens to be a platoon leader at 10th Mountain, so he's headed out to Syria. So what does that mean? I mean, Syria, Ukraine, Russia, and supply chains are really backed up. And we have one client that has quite a bit of machinery, and when a part breaks, he can't get the part, and then he has to get steel, which is hard to get, and then have the parts fabricated locally, right? And how many weeks of delay is that to be able to operate? Not having the people, not having the machines. What does that do to the revenue and the economic output of the business? So technology is accelerating, right? Literally the workforce has changed where they're at and how they work and how managers manage. Values are shifting. There's plenty of CEOs who said that, the heck with it, I'm done working that kind of hours after work, and they're selling their business, right? So that's values of shifting. If you're keeping up in the local press, the Economist magazine and Wall Street Journal, they're starting to talk about the conditions of recession again. So at some point things are going to slow down. So how can we be ready? How can we make maybe the best use of what's to come? So the frame we talk about, these webinars we position these webinars as the bold moves, and this is why we position it as the bold moves. Is let's talk about first what is a bold move. A bold move is often unexpected, is decisively better, and it comes with uncertainty and risk. When done well, a bold move gives you a decisive advantage, right, with your clients, your prospects, over your competitors. And for example, when Amazon offered free shipping with Amazon Prime, that was a bold move, right? And then Elon Musk shooting spaceships, wanting to build a colony on Mars. I mean, that's a bold move, but much bigger than the kind of bold moves most of us are going to do. But just it's from a genre standpoint, it's unexpected. So to think through this, boldness does not mean reckless. The best CEOs know the downside of each decision. What are the options, and what are the potential downside when you're making that move? Could be a new market, new product, whatever it is. You understand the trade-offs, and you have a clear financial flight plan. And that way you can monitor when you're implementing, are you over or under what you expect, so that you can proactively make adjustments. In our world, the growth CFO protects the CEO from the downside. Let's figure out how to do the bold move plus other operational moves, and the growth CFO protects the CEO from the downside, which is often, let's make sure we have plenty of fuel in the tank, we don't run out of cash. So according to McKinsey & Co. are authorities on making bold moves. They have a really well worked out research published in their book, the strategy beyond the hockey stick. And what they talk about is for whatever market segment you're in, we're not competing against the Amazons of the world, but for whatever market segment we're in, getting into that top 20 percentile, that 80-20, that top 20 percentile, it produces on average 30 times more profit. And then for every extra dollar of profit, you're getting some multiple payout in your valuation, right? Your value increases as your profit increases. So literally with a strong valuation, you get paid twice. And according to McKinsey's research, when CEOs do business as usual, 8% of the time they move to that top 20% in their market. If you're doing 2 bold moves, your odds double to 17%, right? And this is where the payoff is. The odds double is not too bad. If you're doing 3 bold moves over a period of time, your odds increase to 48%, so 6 times more of getting that premium outcome that you're looking for in your business, so that you can do the things that you care about. So the how, that's the what and the why. And the how is focus on the obstacles to growth. Like one of them that we're looking at today is low financial performance. Establish the habits of financial management. We're going to talk about 3 of them today, 3 out of 5. And then develop your managers and your employees and team members to literally use the numbers well, both financial and non-financial, that daily dashboard, so that they can help you fly the plane, right, and stay on course proactively. So that's what the bold moves are all about. And with that, Jose, what is inflation? Let's set a foundation here. What inflation is and how it impacts us.
So thanks, Kirk. If you're like me and my family and my friends, the conversation around inflation is coming up a lot. And I started life as an economist, and I went in, and then I became a banker. Then I did a bunch of other stuff, and it got me here. And inflation, what I want to do with this first couple of slides is just really talk about what is inflation in the sense of let's have the exact same language, because that's where we get into a lot of miscommunication. So inflation means some things to some people, something else to other people. So what we're talking about here is in the simplest sense and in the most classic sense, inflation is the increase or the decrease in the purchasing power of your dollar. That's what it is. It's the general price increases. So that's, the same thing today will cost a little bit more a year from now, or a little bit less a year from now if it's inflation or deflation. But it's nothing more than the change in the purchasing power of your dollar. So Kirk, give me the next slide, please. And how do we measure that change? It's a basket of goods. This basket of goods has changed over time. I don't know if it's every 5 years, every 10 years, or it's necessary. The basket that the CPI is measured on changes to try to align with what Americans are buying on a regular basis. Okay, so just like the visual we've got here, it really is just a basket of goods. And if that basket of goods costs 10% more today than it did a year ago, that's 10% inflation. It's literally as simple as that. We always want to keep it couched around the idea of what does the CPI measure, and what does the discussion around an inflation rate, what does that measure? And it's exactly that. It's a basket of goods. Kirk, next slide, please. I put in this slide because 2 reasons. One is I used to love Big Macs. I don't need them anymore. But I'm a big fan of The Economist. I've been reading The Economist since undergrad, so it's been a very long time. And every year they publish their Big Mac index. And it's really what does it cost to make a Big Mac anywhere around the world? Because a Big Mac is pretty much consistent anywhere you go, you order it. Doesn't matter where you're in the world. And likewise, for that very same reason, just in the US, if you look at the price of a Big Mac a year ago, the price of Big Mac today, that's a good indication of what inflation really means, or what's that impact having on you. Whereas my previous slide was this marked basket of goods, which can be a little, let's say, amorphous, no? But when you think about just a Big Mac, okay, that's something that really has not changed. I don't think the Big Mac's changed in 60 years or whatever, but something that really hasn't changed. So if you see the price differentials in the Big Mac, for the most part, a Big Mac's a Big Mac anywhere in the US, and as prices have increased, that's probably a reasonable way for you just to understand how's inflation perhaps affecting me. All right. So next slide, Kirk. So what causes inflation? This is a big conversation. Classically, a lot of folks will say inflation is because the US government has printed too much cash, too much money has been printed, I mean, I can spend a lot of time on this. It's not really they're printing cash so much as what the open market committee is doing, but we'll save that for another webinar. But that's a classic thing. People go, oh, they printed too much cash, and now there's too much cash chasing the same amount of assets. And to a certain extent, that's correct. On a demand basis, if you think about it in terms of a demand basis, that's not too far off. It is money, cash, chasing after a same amount of goods, i.e. supply and demand. There's demand for those goods, the prices will increase. And that is a form of inflation.
Yeah.
Okay, so keep that in mind.
In the current world, we have a lot more cash. We have all the economic stimulus, and there's actually fewer goods. So you got both. If the definition is too many dollars chasing too few goods, you got all the stimulus money, and you got fewer goods because of the supply chain. So it's kind of the kind of a perfect storm.
Yeah. So you throw in what we're coming out of an unprecedented time period, right? The last 2 years is something we've never really experienced, certainly not in my lifetime. Because once and just going back to this, what causes inflation is a demand basis, it's a cost basis as well. The other thing we have to keep in mind, it goes back to this point where I was starting with the unprecedented times, is cost of labor is going up, right? We got the great resignation, as it's been coined, but it's people realizing perhaps I don't want to do this job for this anymore. And any capitalist economy or any free market economy, labor is an input. So if labor wants to get paid more, your costs are going to go up. So there's a lot of things moving on around here with regards to supply chain disruptions, less goods, you got all this cash, you got labor saying, I don't want to do this anymore for this price, or I want to go work in another job. And right, we're seeing that. We can get it during Q&A, we can get into some of the things we've seen with current clients. But what causes inflation ultimately is complicated. It's not simply the US government printing too much money. You really have to think about it in terms of a free market economy. And like I tell a lot of folks, you want to live in a free market economy. That's what you fight for. That's what you get excited about. Well, inflation is just part of that. It's reminding you that you are in a free market economy. That's something to keep in mind, okay? So inflation is not just the government deciding, pressing a button, printing more money. It's very complicated as to what's happening. In some cases, it is too much cash. In some cases, it's a change in your cost basis. And today, it's really labor. Labor costs are going up very, very quickly in an unprecedented way. And to a certain extent, or a very big extent, it's also just the supply chain disruptions. Although these goods are being manufactured, it's hard getting them to where we need them to be because for 2 years we've been shipping things to different places, and a lot of those shipping containers are in the wrong place around the world, and all of that is still trying to find its equilibrium. Kurt, next slide. Is inflation good or bad? As Kirk and I were putting this together over the last couple of weeks, we both came up with the same. We both came up with the same quote. He said Reagan said it. I said Mark Twain said it, but that's because I say all of my quotes I say Mark Twain said them, and it was Reagan who said that I wish I had an economist with only one hand.
Yeah.
Because inflation, on the one hand, it could be good. On the one hand, it's bad. On the one hand, it could be good because right now, for example, why do we have inflation? Because we have a very hot economy. It's generating jobs, right? That's driving prices up as labor is trying to find equilibriums. On the other hand, it's bad because prices are going up. So for every dollar you earn, you're able to buy less. Now, the other thing as we're having this, it became a conversation, a lengthy one at that, was also depends where you are and where you are economically. At the high end, if let's say you're above a certain level of income, inflation isn't going to impact you that much. Yes, you might say, oh, my gas prices are more expensive, but it's not going to really stop you from doing the things you need to do. But if you are in a lower economic position, that extra dollar for gas it's going to hurt you. So once again, on the one hand, it's a bad thing. On the other hand, it's not necessarily a great thing or a good thing, but you can deal with it, you can manage it. And that's probably what it really comes down to. Is inflation good or bad? It depends on where you're sitting, but more importantly is, can you manage it?
Yeah.
How many options have you created for yourself through foresight?
Yeah.
And I'm using that, intentionally. Foresight CFO can help you with this, but with foresight, and you prepare yourself for these situations so you can manage it, you can mitigate it, and come out at the other end of it, if not better off, smarter off.
Yeah. So Jose, I mean, the pros are in general bigger paychecks, which stimulates the economy. People are buying more. And if if you have debt, like your mortgage, your car, whatever it is, you're paying the same number of dollars, but you're making more dollars on the paycheck side. So the pro is that, and the reverse is true if you're a lender. I mean, you're getting paid today's dollars, which are worth less than that fixed amount for your lending. So yeah. The target rate for a healthy inflation is about 2%.
Yeah.
Plus or minus, but definitely where you sit, your lifestyle, your business, you can weather it easier versus harder. But there's definitely pros and cons. 2% is considered healthy. The economy, the wages are increasing, prices are increasing. Some kind of steady state theory like that.
Yeah, I want to go to the next slide, Kirk. Because now what I want to do is kind of try to put this in perspective. So what you're showing here is from the Bureau of Labor Statistics. It shows that that inflation right now has just clipped right above 7%. But they're forecasting is for this to start to go back down to something more normalized, like the 2% that Kirk just mentioned. And what's driving that? Again, it's labor markets finding equilibrium. It's also the supply chain starting to find equilibrium. And all of these things starting to come together. You look at what happened over the last 18 months. I mean, just look at that graph from, basically first quarter 2020, right? March, April, I remember when we shut down and suddenly I had kids in the house all day long. And you start seeing what's happening. And as we're coming out of COVID, and I'm still confident that we're coming out of COVID, things started to heat up. Why? Because labor movements, the supply chain, things people wanted weren't where they were available. But all those things just start finding equilibrium, and the expectation is throughout 2022, we're going to start seeing what we call inflation starting to steady out, and it won't be such a big problem. Kirk, any comments or anything you want to add to that?
Yeah, I think the new unknown, and I don't think the economists have made sense of it yet, is the Russian factor, right? This is the forecast back in November, December, and Russia, there's a whole bunch going on there with energy and everything else. So we'll see, but this was more or less that this was or is the published expectation that things will normalize into 2023.
Yeah. So if we go to the next slide, this is just a graphic representation. People try to wrap their heads around what's a dollar worth. It's a simple sense is if you got a bank balance of $100,000, or it could be $100, we just used $100,000. 7% inflation means that has a purchasing power of roughly $93,000. Very quickly, easy way to understand what we're seeing with regards to that 7%. And the expectation that things will start to ease off again in the latter part of the year. But once again, it all depends on what goes on with Russia and how that conflict finally starts to literally play itself out. Next slide, Kirk. Again, and what I wanted to really do with these three slides was, first of all, is to kind of put this in perspective, give a simple example of what that 7% means. But now, if you look at this historically, going back to 1970, if you look where we're at right now, November 2021, there's on the far right of the graph, 7%. But look, put that in context. It's nowhere near where we were in March of 1980. I wasn't even in high school. I was just starting high school perhaps in March of 1980. So I really don't remember this. I sort of have memories of the mid 70s, early 70s when I'd go with my dad to get gas. We can only do it, I think, on odd numbered days or even numbered days. We start putting in perspective where we're at right now. It doesn't mean that it's not painful, but also it's not completely out of whack. And what we've seen over the last 30 years, for the most part, other than kind of the crisis there in 07, 08, was we've had relatively low inflation. It goes back to that point of roughly that 2% expectation. I mean, just on what I've been doing for the last literally 30 years or so, for the most part, when I'm building these long-term models and putting together valuations on companies, and we've always had in our back as our rule of thumb, 2% inflation put into the forecast, put it into the forward looking. And now this year we've been a little bit different. We've been trying to figure out what it is that short-term, midterm, long-term. And we've been at that higher range. We're down into 5.4s right now, with the expectation that latter part of the year will end up closer to 2. But when you look at the long-term graph like this, it really starts to, it kind of puts everything in perspective. Or rather, I hope it puts things into perspective for you. And the way to think about the two lines, this is from the Bureau of Labor Statistics. The red line, the blue line is a CPI as measured. And then the blue and the red line is that same CPI, but you back out food and energy out of that cost. But again, they tend to, you can see where they kind of deviate. But overall, if you look at where we're at right now, over the span of things, it is high, but it's not as high as it has been. And the expectation is that we'll eventually start heading back down towards closer to that 2% rule of thumb / benchmark.
Yeah, we lived through worse, so we're going to live through this too. Not to underestimate the losing 7% of value of your money in the bank. It hurts, but we'll definitely live through it.
Yeah.
So we're talking about how to solve.
Yeah. Let's go to the next slide.
Yeah. What actions to take, right?
So this is where we spend a lot of time. Obviously, you're kind of looking at what we've done in the past as a team here at Foresight for our clients, or what we've done individually for our employers or firms we were working with in the past. And it goes back to my comment about inflation earlier, where you can decide what to do and how to treat this, right? It still doesn't mean it's not going to be painful, but it is something that can be managed and to a certain extent mitigated. What's the easiest thing you can do is update your prices. Just be very, very flexible with your price list. Now, I understand not all businesses necessarily have pricing freedom, but be very clear that you can move your prices up and down, in this case up, depending on what's happening. And then the other thing we also tell a lot of our customers is when you're writing longer term contracts, right? Put in there let's say you got a multi-year contract with somebody, put in there a repricing, a clause for repricing. And it could be tied to that current year CPI or anything along those lines. But the idea is to be flexible and be ready to change that if necessary, depending on what kind of a business you're in. You might be changing your prices weekly. You might be changing your prices monthly, quarterly, annually. It all depends on where you're at, but be flexible and always have that in your mind. What we find is a lot of folks get into a situation where they're like, well, my customers won't pay more. Well, you might not know that. Ask. It's perfectly okay to raise your prices, get some feedback, and either bring them back down or negotiate down. But always have that flexibility built into the way you think about your business and the way you price your products.
Yeah, Jose, just to offer something up there, according to Vern Harners, if you guys know him, the Gazelles, EO 13,000 business owner organization, the number one issue that he's seen over, I don't know, 20 years or more working with privately owned businesses is that they underprice themselves to begin with. Right. So this idea of having an annual price at a minimal, an annual price increase based on the CPI, very reasonable. It'd be even better we at least consider value pricing, which is not easy, but let's at least consider that. So Vern is on your side to make those increases.
Yeah, the other thing when we were talking through this and things that have worked specifically in the last year, because we're already seeing this, one of probably the biggest challenge our client base has is how do you keep those A players? Any company, including ourselves, no conversation goes by with how do we attract A players, and more importantly, how do we keep A players? The attraction piece is easy compared to making sure you keep them, happy and engaged and on board. So how do you do that? You can first of all, simplest things, you can just link, an annual wage increase based on a CPI, or more importantly, productivity. If you set those goals, right? Start thinking a little bit outside the box with bonuses. So it's not necessarily part of your fixed income or fixed cost base, but it becomes more variable if you start putting productivity bonuses. And that can make up for CPI changes, for example. Think about longer term, sharing your equity, things of that nature, right? Vesting rights and with as part of a retention bonus. Consider, non-financial benefits of joining the company. It could be anything from flexible work hours to how, if and when they come into work, what those work days look like, and so forth. I have a client who has limitless PTO. As long as the job gets done, you can take as much holiday as you like. There's certain things along those lines that are not going to hit necessarily your P&L directly, but is real valuable to those employees. And that's where it comes down to, is having those conversations with your employees and find out what is valuable to them. It's very easy to say all that matters is money. It's not always the case. People value their time. There's time they can spend with their families, the time they can spend traveling, or the time they can be working for you from wherever they feel happiest doing it. So once again, think outside the box about it. It's not always just about the money. And to a certain extent, if your labor wages are going up, pass it on to your customers. Again, going back to the first point, be very flexible with your pricing, with that price list. Be ready to change it as necessary. Talk to your customers, make sure they're aware of what's happening, right? Test that pricing point and where it goes. The other, it's a big one. I've been in a lot of the, like I said, I spent a lot of time in technology, a lot of time in the airline industry, in different capacities. But the materials, when you're thinking about what you're buying to produce your product, if you've got a certain line item in your bill that's very volatile, and I always use the example of a caterer. Usually, the most volatile item in a caterer's P&L is food. And what happens a lot is when you're pricing out products or projects as a caterer, you're kind of raising and lowering that price depending on what you think the food's going to cost at that point in time and so forth. And this is something that airlines do with a lot of different products, including their catering businesses. But the catering businesses, what they'll do is they'll pass on food to the end user. They'll say, tell you what, whatever the food cost is, you're going to pay for it. I'm going to put maybe 1 or 2% management fee on top of that because I'm going to manage the purchases for it and so on. But what I'm going to charge you for is what I'm good at, which is the logistics, the cooking, getting the food to the right place, getting it to the right table, getting it to the right, guest and so forth. And if you start to take that volatility out of your P&L, several things happen. First and foremost, you get much better visibility into your core business. You don't have the swings up and down. 2, you can start forecasting more effectively, right? And 3, if labor is a problem, you can start to understand where you might be able to free up some cash to pay for the labor once you start removing that volatility. In this case, so I'm using a caterer as the example because it's such an easy one. But a lot of businesses have inputs into their production that can be very, very volatile. And that not only has an impact on your P&L. I get excited about this because this is something I've done for a long time. It not only has an impact necessarily on your P&L, but it's also going to have an impact on your balance sheet. If you've got a material that's going to sit on your balance sheet as part of inventory is going up and down, right? That's something that's going to take up working capital. Again, if you're thinking about freeing up more cash, increasing the value of your business, really think about how you get rid of volatility from your core business and pass on that volatility onto your customer. Yeah. Something to keep in mind. And I think you might be surprised when you think through it how effective it can be. Kirk, next slide.
Well, let me say a couple things here is beware of wage compression. Essentially, you bring in a new person at a higher wage point than existing people. It's not going to go well. And then also think about strategic compensation, like a 3-year vesting retention bonus. So you put part of the money and it goes out 3 years and starts to vest. Things like that could kind of build a different environment where you have more stability versus less. Good. This is probably the 80-20. This is where, this is how we operate. This is how we make money. So this is probably the 80-20 on outcomes. We're also going to talk about the financial side and then investing side, money that's at rest of some sort, plus foreign currencies. But Jose, I'll pass it back to you.
Yeah, thanks. I'm going to start going through some of these next few slides a little bit quicker because I want to leave some time. Since we're a small group, I'm kind of looking forward to having a conversation. What questions might be on your minds. But when you're looking at your rent, your rental contracts, or rental agreements, and any contract you might have, check for price change and inflation clauses in those. Both if you're the lessor or you're the lessee, make sure you understand that. And if you do, make sure it's factored into your forecast and so forth. Whether you're a lender or a borrower, if the payments are fixed, if you're a borrower, the payments are fixed, you benefit. But if your rate's variable, you're going to have to deal with that volatility again. If you're a lender, it's the opposite. If the payments are fixed, you lose. If you can change that to variable, again, there's different vehicles out there and the financial markets know how to do it. When you're thinking about your cash, actually cash sitting on your balance sheet and the cash that hopefully your business is generating on a regular basis, understand where you're putting that cash in. Make sure, our recommendation is once we calculate how much cash you need for working capital, i.e. what you need to keep the business going, day to day, week to week, month to month, anything above that, you can start putting into higher earning vehicles, right? Make that money work for you. Like I said, I was a banker for a long time, so I always think about the returns and the weighted average cost of capital. If you got a big chunk of cash sitting on your balance sheet, you got to get appropriate returns on that. So not only are you running the business, but make sure that cash is working for you.
Yeah.
Kirk, next slide.
Yeah, just to say about those bank balances, three options, you got, better than nothing, but still it's not going to offset that 7% inflation, right? There's a partial offset, but not a full offset. So still losing ground, but not as much ground.
Yeah, when you start thinking about going further, treasuries, you can use those. Find out what vehicles might make sense for you depending on where you are in your life cycle, your company's life cycle. Investments. We're not investment advisors, but we all have investment advisors. It's how do you diversify your portfolio? And again, I'll bring that up a little bit higher. Diversification is important across the board. Think about diversifying your customer base, diversifying your vendor base. Again, reduce that risk. I'm very big, it's my upbringing. When you start thinking about volatility, how do you mitigate that volatility? Because ultimately, inflation is nothing more than volatility in prices, right? That's the common theme that's kind of running through all of this. And finally, you also have to be aware if you're doing cross-border transactions, right? Make sure you understand what the dollar you're paying or the whatever that currency, that euro you might be receiving or whatever it might be, what's that mean to you with respect to what the dollar is worth today? And be prepared to hedge. Bring in a subject matter expert that can help you understand how to hedge that so you can capture more of that value of that dollar that's coming back. If it's a dollar, you know what it is, but if it's coming into foreign currency and what the inflation in the United States, the impact that's having on currency cross rates.
Yeah. And definitely avoid jumping in and out of investment strategies or investment types based on fear, because usually if it's fear driven, like you're running towards gold now because of inflation, you're buying that probably at the worst possible time, buying and selling at the worst possible time. We're not investment advisors, like Jose said, so consult your advisor, but from growth CFO lens, depending on how long you can park the money somewhere, you get different options. With investments, you can definitely, I would hope be beating 7% overall year to year. Otherwise, get a new investment advisor, right? At least 8%, right?
Yeah, on average, the market over historically has returned 7 to 8% per year.
Yeah,
on average.
Yeah. So here's a key point. We'll talk about how to do this through 3 of the 5 habits of profitability, that financial management piece. But here's the key point: is this is normal, whether it's 2%, 7%, whatever it is. Dealing with inflation, build it into how you normally operate, because it's normal, right? You have inflation or deflation depending on what's going on in the world. Just think about it. That just like compounding interest over time builds a good, healthy portfolio. It's the opposite effect with inflation. 3% eroding the purchasing power of your money year to year. It's not good. 10 years into your business, you'll be in a worse place than you have to from a profit margin standpoint, which translates to cash, which impacts the value of your business. So just what we're going to talk about next, and the 3 of the 5 habits of profitability, is just a normal part of your operating cycle, just a healthy part of your cadence. So beating inflation is enabled by 3 proven financial management habits where you win again, and win more. The first habit of profitability is achieving positive cash flow, right? And something that's really useful but rarely done is measure your cash conversion cycle. And what is that, right? That's measuring the speed of money coming into your business and going out. It includes factors like how fast do we bill clients, how fast do we collect the money that's due to us, how fast does our inventory come and go, right? Vendor payments, payroll, tax payments that are coming up, by the way. So we measure the cash conversion cycle to identify ways to accelerate. How do we accelerate the money coming to us and slow the money down that's going away from us, right? And how do we accelerate inventory? Because every dollar of inventory is working capital tied up. In an inflationary environment, any cash, with clients that in AR, you build the client but haven't collected, or inventory, the value of that cash is contracting. Not 1% a month, but at some level it's contracting. So the sooner you get it in, the sooner you get the inventory out, the better off you are. And that's true no matter what the inflation rate is, right? So the habit is to measure your cash conversion cycle at least once a year and identify something significant that if you go from A to B, what happens in your business, right? You're using less capital, so you become more positive in your cash flow. Optimizing the cash conversion cycle, it helps us beat inflation, right? Just for the reason your cash isn't hanging out there. In addition, a second good practice is create your 12-week cash forecast, and that way you're matching up the timing of money coming in versus the timing of money going out. So it doesn't really impact inflation, but it's a good practice with this habit number one. So let's go and talk about habit two. I'm all choked up with talking about the habit of profitability, Jose. Okay, habit two is use the monthly financials like a scoreboard, right? And just like almost like you're at a football game, and you can see what is your actual result compared to what your budget, what you expected, right? And then by looking at that number story, you're taking action proactively before the year is over, so that you can land your plane where you want to land at that destination. So the practice is every month with your profit and loss managers, teach them to scrub the numbers. It's the only way you can have accurate financials. If you think the accountants can key in everything exactly right, they know exactly what's going on in the business from their office, that's just incorrect. The manager scrubbing the numbers and giving feedback to accounting is what makes that financials accurate. Understanding the number story, where you look at the trend line, look at what's going on with the 80-20, that your primary costs. Think critically, if I'm over or under expectations, why? If I'm above flight plan or below flight plan, and teach your managers, let them identify the action, right? And if you're a CEO who's been accustomed to carrying the weight of the world on your shoulders, having your P&L manager do this, you can almost feel the weight coming off, right? Because you don't have to be the one with the only insight to where to take action. In your P&L, watch for legacy costs. There's been more than one. I mean, one cost alone is $15,000 a month, and the client was just paying it for years because it was a habit, but nobody had any idea what that service was for, who was using it, meaning that nobody was using it. So just one cost alone, another $15,000 per month. So watch for legacy costs that aren't being utilized or optimized. Watch inflation. You'll see it in your financials. Or your profit margins eroding, right? Either at the gross profit level after delivery, or at the bottom line. If you see the margins eroding, it could be inflation. Labor and material costs are increasing, or it could be poor P&L management, right? Like that doesn't happen, right? Go for the 80-20. Don't chase pennies. What's really matters, what's really driving outcomes. But by doing this, you're empowering the P&L managers to take that weight off your shoulders. And the habit is to do this monthly, right? It's a skill. Most of us are never taught to read financials. So the first time you put a financial in front of somebody, literally, a lot of times they feel like accountability is coming, right? It's not going to be good. I'm going to look stupid, because most CEOs and most managers aren't taught to use the numbers, so they feel awkward with them, but they're smart. And so if you stay with the habit, by month 3 they're getting used to it. By month 6, they wouldn't imagine making a decision without looking at their numbers first, right? And then that's when you got it. It's like going to the gym, you got that habit going. So that's habit 2. And then we're going to go to habit 4. There's 5 habits of profitability. We're talking about 3 of them here, because it relates to inflation. So habit 4. So now you got your monthly financials. You know what's going on. You got that baseline. You're making decisions real time to be able to land where you want to land at the end of the year. Habit 4 is engineering profit. And that's that 12-month rolling budget. It sounds administrative, but not the way we use it. I mean, you lay out the budget, your different options for growing your business, both sales and operational, and you're doing the what if. What if I do this? What if I do that? And you can see exactly the expected financial outcome. That it's a skill. The more you do it, the better you get. You can see the impact, profit, cash, and the value of your business. To beat inflation, this is where you look at what's going on. What's our average price? what's the average cost going into each unit of sales, and then you know what do you need to do from a pricing standpoint. Can you value price? Do you really know the benefit of what you do for your clients? Because if you can, you're playing in a whole different ballpark. Same thing with labor, materials. You can see it all play out in the numbers, and proactively, before the horse gets out of the barn, you can take action. So that's the key. That's the key thing with this engineering profitability. You're gaining clarity and confidence, right? Like if you're a jet aircraft, you have that radar. You can see what's going on. You have your instruments. So the habit is to do the budget before the year starts. So you go in with momentum. Then at least once a year, mid-year, reforecast, because for sure in June, you're going to know more about how this year is going to end up than you did in December of the prior year. And the thing is, forecast a full 12 months past the current year into the next year. So you're developing that skill to be able to plan and follow through in that 12-month time horizon, right? And the bonus, you go into habit 5 analysis, get the benchmarks, the competitive benchmarks for your industry, and then you can see beyond your internal information, where do we stand? Where are we better? Where are we worse? No judgment, but why? And then you can figure out to take action to be able to meet your goals even better. So, Jose, do you have anything you want to add to the habits before we go in for a landing here?
No, I think that the key message with the habits is, and it goes back to kind of where we started, what you have to always be prepared is to manage, mitigate, and work your way through this inflationary period. Simple as that. And the beauty of the habits is they work. If you do them all the time, you're always going to be prepared. And like what we tell everybody, you might not always like the numbers you see, but at least you know what the numbers are. And when you know that, you have the confidence to start making decisions that it's going to take you someplace, and hopefully in the direction you want to go.
Yeah. I mean, habit 1 is cash. Habit 2 is actual profit. And then habit 4 is engineering profit going forward, right? With those 3 things, you can beat inflation. Okay. To tee up the value of doing that 25-minute discovery call with me, our clients speak about the momentum we gain. We gain faster than they expected. We hit the ground with 3-person teams. The CEO is working with their growth CFO. That behind the growth CFO is that the full team, and the growth CFO is guiding the CEO across the full journey from foundation to those 7 succession options, and what outcomes they want and why are those outcomes important to you as the CEO. Invariably, this increases the profit, household income. You get a more valuable business, so you get paid twice. And if you build it well with the 8 drivers in your favor, the business is not dependent on you, so you get your time back. So now you have freedom, right? You have the financial resources and the time to pretty much do what you want when you want, based on what you care about. So I'm going to encourage you guys, take me up on my offer to schedule that 25-minute call to really get in about what you want to get out of your business and what's keeping you from there. And make inflation beating just a normal part of what you do, because that way you're not compressing those margins. You can't figure out how to get out 10 years into it or 5 years into it, whatever it is. Okay. So appreciate you guys joining us. A small tight group, but we would love to be on a call with you to go more about your specifics. And Jose, anything you want to say before we adjourn here?
Well, actually, I was going to say we've got a couple minutes. I'd love to hear if you have any questions, anything we can, make this more of a conversation than just a presentation.
Yeah. Hi, can you hear me?
Yes, Andrew, we can hear you now.
Yes,
we couldn't hear you
this
earlier.
is Andrew. Yeah, sorry. Yeah. Yeah, thank you both for this presentation. I have a question on the slide. Just 1 second. About how do I... No, I'm sorry. It's a slide about pay a player, labor competitively. Yeah, if you can go to that slide.
Right there.
Yeah. About, let's say, the first 2 bullet points. Could you elaborate a bit more, or maybe you can give us some examples? Yeah.
So the one example about strategic compensation that comes to mind for me, and Jose, you may have other ones. If you think year-end bonus, right? You pay somebody that you work a year. Some people wait to get their bonus and they plan to go somewhere else. So it creates this instability period. If even 10% of your staff goes somewhere else, it becomes fairly painful. But if you take either all or a portion of the bonus and put it into a retention bonus, so they have to, in 3 years, they get 1/3 of that bonus. So if they've been with you for a while, the bonuses are coming in, the payments are coming in, and if at any point they decide to leave, they know they're basically walking away from some amount of money. It's tangible. So that creates kind of a strategic reason for staying and really being part of your business. Jose, I don't know if you have any examples about strategic compensation or the first bullet there.
Yeah, we've been seeing, and I've been modeling this quite a bit for various clients, is what does it mean, A, to give folks, some kind of a CPI indexed pay raise, but more importantly, how do we create those bonuses that are sticky? And one end of the spectrum is certainly the idea of the retention-based bonus. You spread it out for several years, you got to make it worth their while. At the other end of the spectrum is the bonuses, break them down into more specific goals. These are MBO bonuses, right? But you make them attractive enough that the folks are going to continue to work for it, and they know. And maybe those goals are part of a longer, 1 year, 2 year goal, and those bonuses are paid out in time. So we've been working with a couple of HR SMEs. How do I phrase this without giving away too much away? But to structure and see what structuring bonuses like that what impact that has, obviously, on the financial statements. But more importantly, what does that have on reducing volatility, which is a big deal for me, right? How do you reduce that volatility in labor going away, but keeping people engaged, keeping people, feeling like they're being properly rewarded, and putting all those things together? Because again, if you can start putting these multi-year plans in place and start thinking multi-year, especially when it comes to labor, increases and decreases in CPI or inflation and deflation are going to have a less of an impact on you over time.
Okay.
Andrew, I'll say one more thing. I'm interested in kind of what you're seeing. If I think about it, back in the day when I was working for a paycheck, the annual increases were never a good experience, right? I don't think most employees are happy with the outcome, and so what do you do, right? I mean, most time employees can get a bigger pay raise if they go somewhere else, if they literally change job. They get revalued at the new job based on their potential, not based on their actual productivity. So it's kind of the wage thing is not easy, especially as you grow in size. You get past, when you first start, you're a hunting party. People are loyal, they're part of the mission, that kind of stuff. But as you grow, things become formalized, or tiers, roles, it becomes more complicated. So the whole idea of linking annual wage increases, especially if a person is in a delivery capacity, they're actually bringing in money. Are there, I don't know, creative ways or to tie their compensation to what they actually produce? A lot of times people in the same seat don't produce the same outcome. Mm-hmm. And then the person at least feels empowered. If they want to do better, they can do better, right? But it's in their hands, not in somebody else's hands. So it's worth kind of figuring out, because most times it's the A players that they can reprice themselves by leaving to go to another company.
Yeah. Long story short, it's complicated and tricky, and everybody is taking this very seriously again, whereas we weren't for probably a decade.
Yeah, let's see what Andrew. So Andrew, we're giving our concept in general, but what are you looking at specifically?
Yeah, basically it's just how we develop a plan, actual plan. I understand the thinking behind this and also the rationale. It's really based on our company's current situation. How do we develop a plan, a solid plan, and implement that plan? That's really my consideration at this point. But thank you both for your comments. I think I may want to schedule a separate meeting with you. Yeah.
Yeah, and that makes a lot of sense. I mean, you're saying be intentional. This is work. There's not an easy answer. Figure out the financial models, make sure it all works and stuff.
Yeah, I understand. It's complicated, really. there are many factors into this. Yeah.
Yeah. So some people we've seen where some people, they don't want more money. They just want to be able to live in Montana, right? Instead of New York City. And I'm an extreme example, but definitely seen that where, hey, I don't want more money. I just want to be able to work from home permanently
Okay.
for whatever reason. So there's good stuff. So I would love to hop on a call with you.
Okay. Thank you. Yeah. Thank you both.
What about, I don't know, Barry, any thoughts from either of you two, Adrina or Barry? Okay, we're hearing nothing. We're happy to talk with you. We're been around the block a few times, so we're good to brainstorm, look at options. But the business climate is good. There's gonna be lots of demands for the companies who are ready for it. Even if there's a recession, be ready for it, right? We've seen companies pick up their competitors for literally $1 consideration because the competitor was going to go out of business, and they just wanted somebody else to pick up their clients and their team members, and $1 is legal consideration. So so just be ready, have your eyes open, use those 3 habits, and there'll be a lot fewer surprises and more confidence when you're making decisions, plus the capacity to follow through. Okay, so we'll leave it there. I'm glad you guys, it's a small group. We're going to get a bigger, we have a tight database. So we're going to get a bigger database and we have more discussion, but really glad that you guys came in.
Yeah, thank you very much.
Okay.
Thanks for taking
Thank
the
you.
time.
Have a nice day. Yeah.
Bye, everybody.
Bye.